Welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and I'm part of the Ameritas Advanced Planning team. We're joined here today by a new member of maybe not the Advanced Planning team, but the Ameritas team. Andrew Gunning, you want to say hi to the Future Focus audience? Awesome. And then we have Jacob. Yeah. If anyone's paid attention to Future Focus, we know Jacob's on the Advanced Planning team. Say hi so people can.
Yeah, you got it. Hey, Troy, welcome back.
All right, thank you.
Good morning.
Still haven't gotten the catchphrase yet?
No catchphrase yet.
Okay.
We're working on it, so got a few things we're going to test out here towards the end of the year, but nothing yet.
All right, so before we dig into our topic today, which, spoiler alert, it's, we're going to talk about things, around retirement plans. We're going to talk about myths and mistakes around the retirement plan, or retirement planning, I should say. Before we do that, though, Andrew, since you're new to Future Focus and you're new to the Future Focus audience, why don't you tell a little bit about who you are, what you do, and we can dive into the episode.
Great. Thank you, Troy. Thank you, Jacob. Yeah. Great to be here. Yeah, my role is national accounts and partnership sales. So to make that simple, I just make sure that our product is on the correct shelf space of all the partners that we work with, so that we are in a position to win and use our best features so that our wholesalers can win with their retirement plan sales.
So just so you know, like we have this thing that we call the jargon jar. Mm-hmm. So our job here is to not necessarily talk Ameritas, but talk the problems, the ideas, the concepts, the things that our audience has questions about.
I think the whole goal is making that complex simple, and if we don't do a good job with that or say something that's too jargony, in goes the pebble.
In goes the pebble. And you can see that we have not spared ourselves.
17 episodes?
17 episodes.
Yeah, so, there's more than 17 pebbles in there.
Yeah, well, I'd love to say that I only threw in one an episode, so
okay.
That's not the case, especially for anyone that's been around. So
we'll keep you honest.
All right.
We'll play fair with you today.
Love it.
So today we're going to talk about confusion in and around retirement plans, mm-hmm. or retirement planning, I should say. So not specifically retirement plans, but certainly around retirement planning. Usually we'll do an episode called Myth or Reality. This time, myth or mistake in and around retirement plans and planning. That's what I'm going to ask you, and then you guys can just tell me what you think.
Great.
Good.
All right.
Sure.
Makes sense. All right. So let's go ahead and dive in. Okay, so the first myth or mistake, number one, that we want you to react to. What do you say to the person who says, "Hey, I'll just take my RMD. I'll just take my RMD whenever I want." And for those of you who wonder if I'm going to put that in, I'll just go ahead and take the hit, because I'm expecting someone to define what RMD is, and I'll just say it out loud. RMD is required minimum distribution. Unfortunately, that's what the IRS calls it, so I have no way around it.
Hey, you beat me to it. I was actually, as soon as you got done talking, I was going to be the very first thing I said was RMD. Sounds like jargon, in it goes. But you described it, it required minimum distribution. And, you had mentioned, I'll take my RMD whenever I want. Well, if it's required is in the name, well, then that's a myth. So what's an RMD? What that is, you said required minimum distribution, but what that means is that's the minimum amount that the IRS says that you must withdraw each year from certain retirement accounts once you hit a certain age. And we'll go into what accounts and what ages those are, but with that description, because it's required, because there's a minimum amount you have to take, you really don't have a whole lot of flexibility, in you are able to take that whenever you want.
Right. Anything?
No, I like the answer. It's increased the age which you have to take the required minimum distribution over the years based upon life expectancy. So that's a good thing, because people were, and they've kind of lessened the 70 and a half was the year April in which you turned 70 and a half. So they've lessened it a little bit as far as the confusion. So that's good.
I think it's gone from
Yeah,
It's
so
up to
let's
73,
mention
yeah.
those ages. So
Yeah.
you had mentioned previously, depending on how old you were when you needed to start taking them based off prior rules, it might have been 70 and a half or 72. Right now, it's currently age 73. Starting in 2033, so in about 8 years, it's going to age 75. And when you need to take that first RMD, that's April 1st after the year that you turn 73, then after the first year is by the end of the year each year. So long way of saying right now the current age is 73.
All right, so let's keep moving. A lot of folks, will have questions about RMDs. There's a lot of sort of consternation around it. What should I do? When should I take it? How much should I take? Should I take more? I can't. You shouldn't take less. There's penalties and all of this stuff. So
there we go. I guess real quick, so for like a little 30-second bonus clip, you mentioned take more. So required minimum distributions, those are the minimum amounts you have to take. Like what you mentioned, you can take more than the RMD amount from these accounts if you need more in retirement to live on. And, you just have to take at least that minimum amount. And then, we had talked about, you can't take them whenever you want, but you do have flexibility of when you can take it throughout the year. If you want to take it on a monthly basis, maybe you want to take it quarterly or annually, you have an option of when you can pull those funds out of those accounts that are needed. Just it has to all be by the end of the year. So there's a little bit additional details to share with our listeners.
But
Would you agree that this happens often after people retire because of the age that you see that's required? So a little shout out to our financial professionals out there that it's one thing that you really want to bring up with your clients.
Right.
Because they're not getting that reminder through work, through the 401k plan, through the retirement plan at work. It's usually after they retire. Would you agree?
Yeah, it's something
Yeah.
you have to be aware of and plan for and have
Right.
those conversations to make sure that you are aware of what the impact of that is, especially, because the accounts that need RMDs to come out from they're growing tax deferred, but those distributions are all taxable, that could impact your situation. So
Right.
talking with a financial professional, understanding the impact of when to take the funds out of those retirement accounts makes a lot of sense.
And this is probably a good time to, we say it every episode, but we are not sort of advocating any sort of specific advice or recommending a specific product. We're aiming towards general education, right? That's that's the whole purpose. So when we, like we've said many times, seek out a financial professional to help with those recommendations. That's where you go and get that piece. But okay, we gotta go faster. So let's because I'm getting I don't want to get the evil eye from behind the camera.
I blame Andrew.
It's all my fault.
All right. Okay. All right. Myth or mistake number 2. All my retirement accounts are treated the same. Now that kind of begs a question. All what retirement accounts, Jacob? What might I be referring to?
I think
What might someone be referring to?
I feel like I'm going to throw in a lot of pebbles
Yeah,
with this
you might as well
phrase.
just pick up that handful.
We got 401ks, 403bs, traditional IRAs, simple IRAs, SEP IRAs, Roth IRAs. All of those are not the same, so I think we'll just have to throw in about 4 or 5 for
we
those.
may have a record, folks.
So
that's a record.
That's quite a bit, but no. You hear all those terminologies. All those retirement accounts are not the same. Things are going to differ from tax treatment, from contributions going in, withdrawals coming out, are required minimum distributions required. What are contribution limits? Is the employer going to contribute to these plans? So and we can go into any and all of those details that we want to, but no, all retirement accounts are not treated the same. There's differences that you need to be aware of and understand the impact.
And for you, Andrew, like I met, like you see it on the, like you're on the 401 on the retirement plan side,
Right.
a specific set of a specific set of retirement plans that some encompassed in that list that Jacob talked about. But do you find that the participants that you may come in contact with, do you find them like they conflate all of them together? Like they all work the same? Is that what you see?
I think so. I when you hear retirement, largely the only resource that a participant or an employee has is their retirement plan at work. So when you're talking about extra retirement plans, and I'm not going to repeat them because at the risk of
No, it's okay.
throwing pebbles in the jar.
Once it's been mentioned,
Once it's thrown, it's
fair
free
game.
game.
Oh, okay, all right.
You can
No,
say
but
401k
the
a
IRAs,
dozen times. And
the IRAs and the Roth IRAs, yes, you do think that it's all treated the same. And even within the retirement plan, in the corporate level, there are different accounts that different products and accounts that you have to make sure they know the differences of.
Okay. So, all right. So we're gonna come back to differences inside of the plan. So let's focus, and this one will be right up your alley.
Great.
Let's go to myth or mistake number 3, which is my 401k, right? Participant plan, like my 401k is on autopilot. I don't need to rebalance. And you might as well just grab one because you're gonna have to explain rebalance. So I'm gonna tell you that right now.
Man, this jar is far-reaching. I like this.
we're gonna need more guest appearances so we can keep filling up the jar.
I feel like someone needs to say we're gonna need a bigger boat.
It's a great question, and it's important to say rebalance because we do promote that someone can put investments into a product that allows them to kind of set it and forget it, that takes care of it, which is one of the answers to helping rebalance automatically. But yeah, rebalancing is very important.
Tell us what rebalancing is.
And
you need to go ahead.
All right, I'll just put it right in there.
There you go.
Rebalancing
Now you're in the game.
is making sure that your retirement plan, when you start out, grows and compounds accordingly. Because let's give an example. Let's say the investments that you're in explode and do very, very well, right? Let's say they're the stock portion of your investments, right? They do very well, and you just leave it there. Well, you're going to be disproportioned into that stock portion versus it might be too aggressive for your liking or your approach. So in order to make sure it's the same as what you originally started out with, they suggest that you take a little bit off of that growth from the stock, put it into the less performing investments, and balance it out again so that it's growing from the same place. So that's what rebalancing is. And, a lot of the organizations, all of the organizations that you can work with have different things that help you do that automatically.
Yeah, and what's nice is you can rebalance, you can change, you can have it be quarterly, semi-annual, or annual. And to what Andrew was talking about, let's say and each person's asset mix is going to be a little different based on their risk profile and their personal situation. But to your point, if it's, let's say it's 70% equities, 30% bonds, to your point, if the stocks perform well, now maybe that 70% goes to 80, but now you're at 80-20 kind of and that's might be too much risk exposure for what you originally intended. So the rebalancing helps with that. And it's the same with the bond portfolio as well too. If bonds, perform better and maybe then it goes to 60-40, the rebalancing helps have it be on the risk profile that meets your particular situation.
So that's one of those things that set it and forget it can, giveth and taketh away, right? Like I set it and forget it and as far as contributions, but without rebalancing, set it and forget it sort of takes it away. Prevents you from getting off kilter.
Yeah, autopilot sounds convenient, but it's not entirely true of what you want to do. You still want to check in on it on a regular basis, and you don't want to just set and forget it. You want to make sure that what you're doing still meets your goals and your risk tolerance.
And in order to do that, there are literally buttons you can push on the participant website that say, all right, go ahead and automatic rebalance for me. And it's generally for those that are doing it on their own, creating their own portfolios, picking their own investments. To combat that automatically so that they can almost set it and forget it, a lot of the record-keeping partners will.
There we go.
A lot of the organizations that offer retirement plans to the employer level will have investment accounts like target date funds and managed accounts. And those are types of products that are based on either the investment philosophy of that individual, what they determine through risk scores and quizzes, or the investments that are the target date are based upon their age. So generally it's more aggressive when you're younger. That's the philosophy. And it gets more conservative as you get closer to retirement to save for that money when you need it. So those are vehicles that you can use to automatically rebalance so that you don't have to do it yourself.
Yeah, and I would say even if you are using a target date fund to try to have 5-year 401k on. He already said it.
I know.
And and I only got one left. I got to save that. You know, you still want to take a look at your account and make sure it still meets your goals. And like you mentioned, you know, the target date fund, you know, that's adjusting that allocation over time based off your specific retirement year. So, you know, if you're saying, hey, you choose a fund, you choose the year of what you want that, you know, you plan to retire, and like you said, it starts aggressive, it becomes more conservative. Over the time, you kind of hear that reduced risk as a glide path. And so, but even in that scenario, you still want to look at things on a regular basis.
I'll put it in there for glide path for you, just so that you know.
Like it. I love this one. I just get to ask questions and not have to put in any. So, okay, let's keep moving. Let's stay in the 401k realm. Myth or mistake number 4. I'll just cash out my old 401k when I change jobs.
Yeah,
And I'm gonna place my hands squarely in God no.
Yeah, because
Right.
in reality, yes, you can do that, but is that really the most effective and efficient way to plan for these dollars that are aimed towards using in retirement?
Right.
Yeah, so a mistake, if you want to, you know, it's not a myth, it's a mistake. Now it can be required or appropriate or necessary for someone to do
If someone
that.
has an emergency,
Yeah,
they
of course.
absolutely they absolutely need to get to those dollars for whatever reason. Then I think they still probably want to talk to a financial professional and say, hey, are you sure? Because, you know, from a standpoint, we talk about 401ks are tax deferred dollars.
Correct.
You take a distribution, you have to pay taxes. If you're under 59 and a half, we've talked about this before, you have that extra 10% penalty.
Right.
So you have taxes, you have penalties, depending on what tax bracket, tax rate you're in, it could be a substantial impact to your tax situation.
Okay, we're gonna make the complex simple, right? And we know that we can't give specific advice. We know that we can't and we don't want to give specific advice. But I'm gonna go ahead and say that unless there is something dire, I don't know if we want to be accessing, you know, the
100%.
the 401k
Let's say
because I'm changing jobs.
Most people are going to agree on that statement, mainly because when retirement planning is that long-term planning
Right.
for retirement, taking those dollars now. Oh no, I hit it. I'll put it back. I think
No,
that's
it's
where.
too late.
No,
It's
it was
messed up.
You didn't see it. No one saw that. But no, I mean, it's
They're not smiling, by the way.
No, I see some chuckles. I was so passionate about it.
Let me help
start
here.
getting flapping around.
Let
and
me
I
help
hit
you.
things.
I started my career in this business 30 years ago as an enrollment coordinator. And what that meant was I went out after the plan was sold to the company. I went out and educated the employees on how to get in the plan and what the features and benefits were. And we focused a lot of time on this. And my message was, this is money that you need. You can't open this gift up until you retire. And we focused on that. So if they do leave the company, which happens more now than it ever has with the demographics you see now, you can roll it over to your next job. You know, you can roll it. You can leave it in there if they want to, right?
So you can cash it out.
Right.
You can roll it over.
Right.
And that means, and when we say roll over, that means move it from one company plan
To the new, yeah.
to the new
if you're
company
going
plan.
to a new job, right?
Doesn't roll, but rollover has another meaning. Like you can roll it over to
That's another option, right? To a tax deferred
IRA. Yeah,
right.
there we go.
Tax deferred IRA at your bank if you
Right.
want to, right? Keep it tax deferred so you don't get hit with what you don't get hit with what Jake was saying with the tax
taxes and
penalty,
penalties,
Yeah.
right? The 10%.
And then so cash it out, roll it over to an IRA, or roll it over to the company plan. And what's the?
You could cash it out, which we already talked about.
Yeah.
You could leave it.
leave it,
in
yeah.
the
Oh,
old
yeah, you can leave it in the
401k,
company plan.
Depending
If
on
they
the
let you.
depending
If they let
on
you.
the size, if they let you, if it's a smaller amount, sometimes they don't. But you could technically leave it there. Maybe the investment choices are really great. Maybe the fees are low, and it makes a lot of sense to leave it where it's at. You could roll it over to the new employers. It lets you consolidate the benefit there is you're consolidating this account and that account. And now you just have one to keep track of. You mentioned
Assuming you're doing it on your own.
Yeah.
Right. Like you may seek out a financial professional and so on and so forth. But
Because there's going to be paperwork that's required to do that rollover, same as if you move it to an IRA. You could even, instead of rolling it to an IRA, if these are pre-tax dollars, depending on the size and your situation, maybe you look at a rollover to a Roth conversion. We've already talked about Roth conversions in the past.
pre-tax dollars, though, we
Yeah,
never.
I think we talk pre-tax. Those, dollars that they're tax deferred. You haven't been taxed yet on those contributions. So those you get taxed on the distributions out when you take the withdrawals. Other option is you could do a Roth conversion with those. You could roll it over to an IRA, but roll it to a Roth IRA. Do a conversion. Now the impact.
That's tax consequences on that.
Yep.
Though.
Now the impact there is you have to pay taxes. So depending on what that balance is, if that makes sense or not, that's something you need to consider. And maybe it's partial conversions, but that's an option as well too, to start building up some tax-free dollars in retirement if you don't have that component yet in your planning.
Either way, that's 4, 5, 6 maybe options. Again, unless you're in dire circumstances, all of which are in my opinion better conclusions than cashing out your 401k.
Yeah, the goal is not to interrupt the growth and the compounding effect that you can get on the retirement plan.
Yeah, there's a lot of great options to consider. It's not the right option is not the same for everyone, but knowing, hey, there's 2 or 3 or 4 different approaches I can take with these dollars.
Right.
There's advantages and considerations of each approach, and so it just lets you know there's options out there.
Okay, sounds good. Myth or mistake number 5. Roth IRAs and Roth 401ks are the same.
Myth.
I'm going to say this is usually your answer is easy. Troy likes those answers, but it's a one-word answer.
Yeah.
You get Jacob who starts talking and says, well, and
I don't necessarily like the one-word answer. I don't necessarily like War and Peace. there's got to be a middle
and I
ground.
start talking, and 30 seconds later, I still haven't given an answer. So my answer is this is a trickier one because it sounds close. There's some reality with some shared features, but there are some important differences. So the core benefit,
So if there are differences, are they the same or not?
we'll say they're different. We'll say the core component, that tax-free growth, the tax-free withdrawals for qualified withdrawals in retirement is the same. But
The fact that Roth starts a Roth 401k, Roth IRA, Roth means something.
That component is the same, but there's other components that makes it different to be aware of.
Right.
Yep.
Those differences are contribution limits, right? If you are in a retirement plan at work, there are no income limitations for you to be able to participate as a Roth and can make your contributions as a Roth. So you can put 100% of your contributions in as Roth contributions if you so choose. With the Roth IRA, I think your contribution limits are $7,500 a year, if I'm not mistaken, $7,000 a year in 2025, and the catch-up's only $1,000. So
For ages 50 and above.
right,
So,
for 50 and above, and your income limitations are, I think, $160,000, if I'm not mistaken, $161,000, right?
So Troy laughs at me because here I have my notes. I usually like to have some of these facts in the background. So yes, so 165 for single filers in 2025, 246 for married file jointly. You had mentioned 7,000 plus the catch up for the Roth IRA. For Roth 401k, it's 23,500 plus a $7,500 catch up for 50 and above.
The other thing, too, the other difference is we talked about required minimum distributions, right? Yep. From in the Roth 401k, it is the same as if it was, you do have to take the required minimum distribution out of the Roth 401k. You do not have to in the IRA.
No, not anymore.
It's changed?
This is what I got wrong yesterday.
That's what we were talking about. That's what we were talking about yesterday. So we had mentioned Secure Act 2.0. One of the changes inside there was previously Roth 401k had required minimum distributions. With Secure Act 2.0, Roth 401ks do not. So that's one feature that Roth
I just got an email on the Roth
IRAs
our Roth Secure 2.0 features. I have to read it.
Are the
got it
same.
this
So
morning.
so that's one benefit of a Roth with both type of accounts. And
all right.
Yeah.
Yeah, that
We were talking about that
was
yesterday.
the exact thing that I was like, well, no, this is a difference, and he was like, no. And then, of course, I'm
That's
like,
good.
no, I'm pretty sure this is the difference. He's like, no. I'm like, well, no isn't going to get it. You got to prove it to me.
Yeah.
And
Yeah,
then we have to look it up.
we dived into that a little bit. And what's nice, I think the last thing I'll mention on Roth IRAs, Roth 401ks is it's not a either or if you're under the income limits to contribute to a Roth IRA because they don't have a Roth 401ks don't have an income limit.
Mm-hmm.
You can, individuals, if you're under the income limit for a Roth IRA, you can contribute to both. So it's not like it's a decision that I have to do either the 401k or the Roth 401k or the Roth IRA. Depending on what your income is, you could make contributions to both plans. So it's not an either or. It could be an and situation.
Right.
Now, is there still I'll ask a question that's not on the agenda. Is there still a 5-year clock to start that Roth 401k, IRA, I mean, that allows you to have the benefits? So that's a reason to have both as well,
Yep,
right?
yep. There's still that.
Yeah.
Yep. See, I like it. So go off.
All right.
Took an exit off the off ramp.
That's all right.
That's usually my job. So
love it.
you see, you did bring something.
All right,
He usually
good.
works really hard to go, I know what this outline says,
Yeah.
but look.
That's good.
Okay. All right. That was awesome. So let's talk our last myth or mistake. And this one it's amazing to me, but I've actually heard this conversation. Like I've heard this conversation. Myth or mistake number 6. I'm not sure what I need to do to get a company match. And I'm embarrassed to say that I've had this conversation, not about me, but I've had this conversation with people in the past.
Well, I'll let Andrew go first since you work with our retirement plans and our 401ks. What's company match to define that for Troy?
Sure. If you're fortunate enough to work for a company that wants to match what you put into the retirement plan, it's usually a set amount. Let's say the match, they'll give you dollar for dollar on the first 3% you put into the plan. Okay. So I put 3% of my pay into the plan. I'm getting another 3% from my company match. And it can be many variations up to whatever the company wants to do. So that's what we used to call, and we still call in the business, is free money. So we highlight. Yeah, well, you could strike it if you want.
No.
Compliance, right? I know what you mean.
I know what you
mean.
Money you're leaving on the table.
Yeah, that's definitely you're leaving it on the
if
table.
If you're not contributing.
So we stress it. Our education folks stress it all the time. If you can afford to do it, you need to at least put in the amount that gets you the most match. If you're fortunate for working for a company that offers it.
Right.
It's fantastic. You have to do. Some plans have matches already built in so that contributions can flow for the employees at a different level. But yeah, the company match is something that you need to focus on when you're being educated about the plan's requirements and about the plan's features, and it's a big thing nowadays. You may be talking about it is the automatic enrollment, right? So the plans are required with Secure Act 2.0 now to have some sort of automatic enrollment, which forces the individual to participate in the plan unless they opt out, and that's really for supporting the retirement plan for the greater good, for the greater participants, to make sure that they get into the plan. And usually those automatic enrollments build up to getting the most match out of the company.
Yeah, I mean, not getting the match can be a costly mistake. I mean,
Right.
just simple math. You mentioned, I think 100% up to 3%. So let's say you are contributing 3%, so you get you aren't doing the 3% to get that 3% match. Let's say, simple math, you're making $100,000. 3% is $3,000 a year that you're not getting as a contribution to your retirement plan.
Right.
That can be costly. And to your point, Troy, that you were asking, the question was, I'm not sure what to do to get the company match. There's resources at your employer. Your employers, whether it's the HR department or your benefits site or the employee handbook, the 401k summary document. Mm-hmm. There's places you can go at your company, at your employer, to get that information on your 401k plan, so you know what that match is and what you need to do to get that.
Our online enrollment system, if the plan has a match, it's identified as such on the system, and it will prompt them to say, "Are you aware, that you're not putting enough in to get the company match?" So you go above and beyond to try to make sure they get that.
Absolutely. All right. One last question, not on the outline. I just thought of it. If you, especially you, Andrew, having like retirement plans is your side of the house, if you will.
Sure.
Number one mistake, myth, whatever. Maybe it's one that we've already done. Maybe it's one that we haven't talked about. If you had to put sort of like, man, I see this a lot, and if we could eliminate this, like, people would be better off. What would that be?
I was fortunate enough to get into this business early on in my career, right? So I understood the importance of contributing to your retirement plan. So just simply starting to make a contribution to your retirement plan is one of my biggest things to promote and one of the biggest mistakes. And I have a personal story. My roommate at the time had a great job and he didn't contribute to his retirement plan. And I kept telling him, Mike, you got to contribute. You got to find some money. Stop, don't buy that extra coffee, whatever the amount is that you can put in. And I saw him about 15 years later walking. I live outside of Boston. I saw him walking through an office building. And this was 15 years ago, but 15 years after we lived together, and he stopped me. He goes, you know what? I want to thank you for constantly reminding me to get into the retirement plan because it's made a difference. So that's my biggest thing is start contributing.
I think I'll add to that. You've mentioned it before. It's not just contributing, but it's investing those dollars. I think we see those situations where they contribute, they do the first step, but they don't do the second step of picking the funds based on their risk profile and their asset allocation for to actually invest those dollars, and those dollars might just sit in cash, not really earning a lot of interest. And so that's, if we're talking mistakes, that's that second layers. Not only
Sound people really like.
I'll put my hands down so I don't keep hitting the mic. Not only do you contribute, but you invest those dollars based on your own risk tolerance
Very
and risk
appropriate.
profile.
Okay, so how was it?
This was great. Thank you.
This was
Appreciate
fun.
it.
You'll have to come back from Boston and join us again.
I hope I've earned a trip back. This was fantastic.
Absolutely. So that's it for this Future Focus episode. I want to first of all thank Andrew for coming in and sitting down with us. I guess I have to thank Jacob. He's here.
I tried. I only hit the mic twice, so
You hit the mic twice. The sound people are mad at you.
I did my part this time. So.
All right.
And I got one pebble left.
And you got one pebble left.
Yep.
I want to remind everyone that we still are going to have our listener episode every 5 episodes. So we still need those questions. If you first of all, make sure you like and subscribe to this episode, or like and subscribe to Future Focus if you haven't already. And if you have a comment, a question that we can use or potentially use in one of our listener episodes, just go ahead and drop that below. Again, my name is Troy Branch. This is Future Focus, a financial strategies podcast. Thanks for your time and attention, and we'll see you soon.